Welcome to another video. Today we'll be speaking about how you're supposed to be approaching your analysis from a multi-time frame and order flow perspective. So we will be taking a pair, analyzing it, checking the order flow, and most importantly, I will be giving to you guys some free educational lessons during the analysis. So the video will be very valuable. I suggest you watch it until the end, and I will see you in it. Okay, so let's make a multi-time frame analysis here on gold, and let's see how we can be capitalizing on the next moves on this pair. And I will try to keep the analysis as educational as possible, because definitely there is one very key lesson that I want to teach you in this analysis. So let's start here from the daily time frame. What kind of situation do we have from a daily perspective on gold? Now on the daily, what we can clearly see is that the market is consolidating basically in this triangle formation. So what is it doing? It's basically creating lower highs and higher lows. When a market is creating lower highs and higher lows, basically it will be consolidating in a triangle formation, which is a very common pattern when basically there is a situation of uncertainty. That is what you read on the textbooks. The reality is that basically these patterns are created by banks and hedge funds basically to manipulate you and grab the liquidity that they need for the next moves to the upside or to the downside. In other words, this could easily be a distribution phase for gold. Now, what is the difference between accumulation and distribution? In accumulation, a period is a period in which basically usually after the market makes a move to the downside, you will have an accumulation period in which you have a lot of sideways price action. And what is happening during that period? You're having a lot of buy orders entering the market from an institutional level, because basically hedge funds are buying and they're creating all kind of traps for retail traders to use their liquidity to actually fill in their positions and make the move to the upside, then start in a second moment. And in the same, a very similar situation is basically a distribution strategy. After a market makes a move to the upside, it starts basically this this distribution phase in which basically what happens? They're taking their profits, so they're liquidating their long positions and possibly starting to build up some short positions. Now, what do we see during this basically pattern here, during this triangle formation here that the market is forming? What is going on from a COT perspective? So what hedge funds are doing at the moment on this commodity? We can clearly see that with the last report that we have from the commitment of trader standpoint, we can see that hedge funds have closed 11k net positions, which is a lot of long positions to close from an institutional perspective. And they also added some shorts. So not only they closed 11,000 longs, they also added already 914 shorts, and we can probably expect this number to grow. So basically they are closing out some of their long positions, but actually a lot of their long positions inside of this area. Just a quick reminder, make sure you comment below and you let me know which pairs or topics you would like to cover in the next videos. Now, what is going on from a weekly perspective? Now, on the weekly time frame, what we can see? On the weekly, we can see that basically a gold has made this big push to the upside, and then basically it's at the moment consolidating in which area? Exactly at the previous high. From here, the market had made basically this big move to the downside, and now the market is basically exactly at this same level. Now, from here, we definitely did expect the market to try to create a fake breakout to the upside. What does it mean? It means that this move to the upside above the level might actually be just a fake. And from here, the market actually wants to go lower. A possible target to the downside could easily be this red candle here. Why? Because during this move to the upside here, there is one candle which is of a different color. and it's basically this red candle here. And why this is a very key area basically for this market, because it basically, a red candle here means that here we have a strong demand area and the market might want to go there to actually grab some liquidity. Now, going back from the daily perspective, okay, can we be looking immediately for a short position? No. Why not? Because just because we see them close, we see basically hedge funds close some longs and add some shorts, and just because we would like to see from a weekly perspective the market fail to break higher and create this fake breakout to the downside to go and grab this liquidity, is not enough to just take a short position. Because why? Because the market could easily just continue to the upside, and they will just continue to basically sell every time that retail traders buy, and then from higher the market makes a move down. You never know basically how things will actually develop. That is why trading is reactive, is not predictive. You can't predict the market, but you can react to what the market is showing you and position yourself with the best probabilities and best risk to reward. And that is what your strategy, your rule-based strategy, is supposed to show you. Now, at the moment, our rules are absolutely not satisfied for a possible short position. We can't be looking for a short according to the rules of our strategy. Plus, because we also have to realize a very simple thing. From a daily perspective, what do we have here? We clearly have previous resistance, now turn support here, and obviously here we have not only the daily support from a structural standpoint, so previous resistance, now turn support, we also have the ascending trend line. So obviously we can't be looking for a short yet, but what we might have is a very interesting situation in which we will definitely be interested with students. For example, if the market makes a nice break to the upside of the trend line, okay, then most retail traders will start to long gold. And that could be a perfect basically moment for a nice manipulation and the next candle, daily candle, closing back below this trend line. Now, if this happens, okay, I'm just speaking here of the different possible scenarios that might present itself that would basically generate a reaction to our side. If the market breaks above the structure and then breaks back below the trend line, then what we will be doing with students at that point on the retest of the trend line, because that is what the market is supposed to be doing after a fake breakout, we will definitely be monitoring with students inside of this area for a nice move to the downside, because at that point we have good probabilities and good risk to reward for a move to the downside. On the other side, if the market basically, for example, before breaking to the upside will break both structure levels with a strong push to the downside, then that is even better, because on the retest of the structure, what we will be doing with students, we will be monitoring price action on the 4-hour time frame, waiting for the market to provide to us one of our valid entries. And if the market will provide to us one of our valid entries, then we will be taking a nice short with a good risk to reward and good probabilities for a nice move to the downside. And then obviously there is the third scenario in which the market just breaks the trend line to the upside, doesn't break back below, and just continues to the upside. In that case, we're not interested in the move to the upside. We're okay with missing out on the move to the upside because it's not the move that has the highest probability of happening. It doesn't mean that it won't happen, but our job as traders is to position ourselves with good risk to reward and good probabilities. And for the move to the upside at the moment, we will not be positioned with the best probability scenario. Therefore, if the market does explode to the upside, we will not be interested in that move. But two moves in which we would be interested is break of structure on the retest. From a 4-hour perspective with students, we will be looking for a nice short position if our rules for entry will be satisfied from a 4-hour perspective. And on the other side, fake breakout to the upside, break back below. Again, we will be monitoring inside of this area for a possible short position if our rules on the 4-hour time frame will be satisfied. Because always remember, monthly, weekly, daily, and COT data is very good for the direction of the market. But when it comes to entry, you need clear rules for entry on the 4-hour time frame. Why? Because it's the most accurate time frame, and it will help you in case basically the market doesn't really want to make that move. Basically, it will help you filter out losing trades. Why? Because if, for example, after this break and retest, our rules for entry will not be satisfied in this area, then it means that the market has higher probabilities of just continuing to the upside. Therefore, we will not be entering the market. So it definitely filters out a lot of losing trades if you have clear, solid rules also for entry, not only for direction. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find the link in the description. It's a very complete program. You first learn all the rules of my strategies, and then you trade them live with me. Each and every day I give you a new daily market breakdown showing you exactly how to apply these strategies with entry, stop, and take profit, as well as answering every question that you have each and every day. So I suggest you go and check it out, or go check out the next video.